In this video, we're going to look at Fastenal, and they resell industrial safety and construction supplies. They also offer services including inventory management, manufacturing, and tool repair. They've also been a sponsor of NASCAR since 2006. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. Then I look at the financial ratios of the company, and I do this with you throughout the entire video. So it's like we're doing it together. So let's get started with the model. This company has a market cap of $26.2 billion. It's a pretty good sized company. And they're trading at $45.51. So one share of stock is about $45. Now we're going to pull the free cash flow. And free cash flow is the cash that's remaining after operating a business minus capital expenditures. And the way to value a company or an asset is to estimate the future free cash flows and then discount that number back to today's value, which is what I'm doing in this video. Now I'm going to pull the net income, which is the profit and loss on the income statement. And then I'm going to get the revenue, which are the sales for the company, also on the income statement. And it looks like the revenue has been increasing every year, which is a good sign. The numbers look pretty consistent and healthy. And look, their net profit margins have been increasing every year, it seems. It went from 13% to 15%. And net profit margin is net income over revenue. It's how well the company converts revenue into profit. Now let's look at the capital structure of the company to get more information. So their interest expense is $13.9 million. That's the interest they pay in their debt. And then let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. And current debt is $3 million. That's debt due within 1 year. Long-term debt of $342 million. That's debt due after 1 year. They pay 4% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. Income before tax of $1 billion. And then the income tax is $252 million. So the effective tax rate is 24%. The cost of debt is 3%. To get the cost of equity, we need the beta, and the beta is how volatile the stock. And their beta is 1.18, so it's not too volatile, so it moves a little more than the market moves. And let's go back to the balance sheet to get their current assets. We need current assets to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And that's $2.5 billion. And let's get the current liabilities. This is how much money the company owes within the next 12 months. That's $545 million. And the equity is assets minus liabilities. It's the value of the company according to the balance sheet. That's $2.7 billion. And now we need the EBIT, earnings before interest and taxes. That's operating income on the income statement. And that's $1 billion. We need the EBIT to calculate the interest coverage ratio later. Let's look at the capital structure. The cost of debt is 3%, and they only have 11% debt in their capital structure. The cost of equity is 11.4%, and the weight of equity is 89%. So the weighted average cost of capital is 10.4%. And that's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. And we also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company for $10.4 billion. We divide that by 600 million shares. And we get an intrinsic calculated stock price of $18. They're trading at $46, so they're trading at a 152% premium. So it's a strong sell according to the model. So let's see what Simply Wall Street values the company. They're valuing them a little higher at $26 a share. So they're also saying the company's overvalued. Let's look at the historical stock price. So the stock was trading closer to intrinsic value a few years ago, but it's been driven up the price. I guess the market sees the future of this company being really strong. So in this case, they're willing to pay more than a company's worth. Let's look at the financial ratios to see if we get more information. They have a pretty high PE of 33. That's price of stock 45 over earnings per share at $1.37. And to calculate earnings per share, it's net income, $791 million. Net income is the profit on the income statement. And you divide that number by shares outstanding, 576 million. So the earnings per share is 137. So I like to see it below 15 for this ratio. 33 is not a good price to earnings ratio. Price of sales of 4.9, that's also pretty high. That's price of stock over sales per share. And to get sales per share, it's revenue, which is the top line of the income statement, 5.3 billion, divided by shares outstanding. That's 926. I like to see below 2.5. They have 4.9. And the price to book of 9.8, that's really high. That's price of stock over book value per share. And to get the book value per share, you just take the equity, which is the assets minus liabilities on the balance sheet, divided by the shares outstanding, 463. So the balance sheet doesn't provide a good value to investors. Let's look at the current ratio, 4.5. So they can easily cover their current liabilities, almost too much. So it looks like they're not running their most efficient business. You don't really need a current ratio above 2. That just means they're sitting on a lot of current assets. Their ROE is really good at 30%. I like to see above 20%, so they're providing a good value to their equity holders. Their net income is $791 million divided by their equity of $2.7 billion. That's how you get ROE. And the interest coverage ratio is 76. That's their EBIT, earnings before interest and taxes, on the income statement, divided by interest expense. They don't have too much debt, so they can easily cover their interest payments. So it really looks like a solid company, but the price of the stock has been pushed up way too high past the point where I think there's a value. But let me know what you think in the comments. Thanks for watching.